Good morning and welcome to The Street here on BNN Bloomberg. I'm Paul Bagnall. Thank you for joining us this Monday morning. On today's show, we'll get the views of a market professional on the whiplashing North American stock markets. Was last week's downturn a signal that the rally in the second half of April and most of May has been overdone? Our featured guest will also take a close look at the outperformance of the S&P TSX Composite Index, the Canadian market this year. What sectors have really driven those gains, and does it mean investors should be underweighting U.S. stocks? Finally, we want to hear from you this morning in our first call segment at the end of the show. We'll invite you to ask questions of our featured guest of the morning, Brianne Gardner of Velocity Partners Raymond James. So get ready with your questions on Canadian and U.S. large cap stocks. We'll have Brianne answer as many of your questions as she can. The number to reach us at will be 1-855-326-6266. We'll open the phones in about half an hour from now, and our email address is firstcall@bnnbloomberg.ca. You can send us that question by email right now. In the meantime, let's get started with some stories that we're tracking for you here in the BNN Bloomberg newsroom. U.S. President Donald Trump is pushing back the deadline for his planned tariffs on the European Union. Trump has delayed the threatened 50% tariff until July the 9th after a call with European Commission President Ursula von der Leyen. Von der Leyen says both leaders had a good call and that Europe is ready to advance talks swiftly and decisively to reach a deal. Barrick Mining says the Malayan government's attempt to interfere with its operations in that country is without precedent or lawful justification. The Canadian mining company says it remains available to resume talks with authorities in the country to allow for the release of detained employees and the resumption of operations. Last week, a Malayan court postponed a ruling on Barrick's mine until June 2nd. It's the second time that hearing has been delayed. Shares of Nippon Steel are trading higher. This comes after U.S. President Donald Trump announced a planned partnership between U.S. Steel and Nippon, the big Japanese steelmaker. Trump says the deal is an investment and partial ownership arrangement and would be controlled by the U.S., but details remain unclear. Nippon Steel has proposed a $14.1 billion takeover of U.S. Steel. That's priced in U.S. dollars. Analysts have warned the scale of such a deal could be costly for Nippon in the short term. And now our top story. Investors have watched stocks swing dramatically this spring. A steep plunge in early April when U.S. President Donald Trump announced his so-called Liberation Day tariffs was followed by a huge rally. That rally stalled last week, however, when U.S. stock markets dropped steeply. Where are markets likely to go next, and how should investors be positioned right now? Let's talk about those questions with our featured guest of the morning, Brianne Gardner, Senior Wealth Advisor at Velocity Investment Partners, Raymond James. Thanks for coming in, Brianne. Good to have you here.
Thanks for having me.
What do you make of these markets? It's been a pretty good 5 or 6 weeks for investors who were very worried in the early portion of this year about what tariffs and trade wars would do to their portfolios.
Yeah, I mean, I think we've seen quite the recovery since April 7th, right? It's been actually one of the strongest recoveries we've seen in history. I think even reflecting back for investors, you know, we saw things quite overvalued in the market. For us, we started taking profits, raising a little bit of cash, kind of through February, knowing that looking at valuations, they just weren't making sense anymore. We looked at the forward PE ratio of the S&P 500, and we were at like 21, 22, 20, close to 23 times. And to us, that's quite elevated. And then you're seeing some of the other stocks that are extremely high too. And almost every single sector was in overvalued stage. So for us, and we saw very low volatility, right? And we hadn't really seen volatility coming off of 2022. So through 2023 and 2024 was quite muted. And so we knew we were in for a little bit more of a roller coaster. Then you have Trump come in office and, the cards started moving in themselves. But even off those lows, we've seen the Dow up 14%. We've seen the S&P up over 20%, the NASDAQ almost 28%. So, this is one of the fastest recoveries we've seen in decades. Mm-hmm. And really, April 7th, we saw that Trump announcement, as you mentioned, the tariffs, and the S&P pull back 10% over the next 2 days. Panic set in, the market priced in the worst possible situation. And then since then, we've seen that. But we do tend to see two types of recovery when we see this extreme sell-off, right? Is it a V-shaped recovery like we saw in 2020 in COVID? Or is it a more softer, kind of rounder recovery like we saw in 2020 or 2022, apologies. So we're seeing this as a little bit more of the V-shaped as quickly as the market has been recovering off the bottom.
How do you see fundamentals? What's your take on earnings performance among S&P 500 companies in the most recent quarter, which has ended quite recently? And how do you see the macroeconomic backdrop as being supportive or not so supportive for stocks?
Yeah, I mean, I think we saw at the beginning of the year the broadening out and earnings projection for every single sector in the S&P 500 at least was projected to be positive. And that explained to us, away from narrow market participation we saw the last year of the Magnificent Seven to more every single sector participating, especially materials that, as you can see from the TSX, has done extremely well this year. And that was one of the top performing sectors that was expected to have about 20% earnings per share growth. And we are seeing that participation. So for us, now we're starting to see analysts a little bit more positive on earnings growth after this recent rally. And I also am seeing that, there's other sectors that are still starting to participate in this. So for us, that is more positive and more bullish than bearish for the outlook.
What do your client portfolios look like right now? How are they structured? Yeah,
so we were pretty active through this correction. We look at a lot of both fundamental, obviously the profitability of these companies. And when you're seeing every single stock or everything being thrown out, it's not necessarily making sense to sell great quality companies that have stable balance sheet, good cash flow, reputable businesses, and aren't going anywhere. But we used it as an opportunity, having that cash on the sidelines, to pick up some great stocks that were also sold out. We added NVIDIA, we added Constellation Energy, and also Meta through that correction. And we're pretty active on taking profits again. And right now, we actually see it as an opportunity to be trimming back again, as you are starting to see retail investors pile in. So for us, that is signaling a little bit of a caution here. And we think the markets could tread a little bit sideways or have a little bit more volatility in the short term.
We'll talk later in this half hour about your views on retail investors getting back into the market. The numbers are dramatic in terms of the number of consecutive weeks that retail investors have been net buyers of stocks. If you're trimming, how do you make this decision on what to trim?
Yeah, so again, we have for every single stock that we hold in our portfolio kind of an exit price or a target price that we have for that. And once our model portfolios that we have start expanding outside of that depth, maybe we have a 3% or 4% weight for that position, and it starts going up to creeping up to 5 or 6%, we'll trim it back to our model weight of that 3 to 4%. Also, we're looking at overall sectors, where we want to be overweight, where we want to be underweight, and positioning the portfolio for where we think the second half of the year, we're already at the end of May, headed into June now, where we want to be positioning to be benefiting for that second half of the year. So I do think, looking at valuations, looking at technicals as well, how stretched certain stocks are, and same thing, for example, in healthcare, we're looking at even the sector as a whole is about 15 to 16 times forward earnings, and to that, even drastically undervalued compared to the S&P 500, that's about 21 times. So, we're looking at pockets of opportunity and then valuations that are a little bit too high for us that we are taking profits on to raise cash so we can buy.
That's Brianne Gardner and her take on the recovery in markets that we've seen since the early portion of April. Up next, Brianne takes a close look at the outperformance of the S&P TSX Composite Index. Where have the gains really come from, and can they continue? Welcome back. Let's take an expanded view of the markets. Now, there's no trading today in the U.S. because of the Memorial Day holiday, so we'll skip the U.S. futures, but there's a look at how Asian markets concluded their trading day today. Tokyo up by a full percentage point. Hong Kong fell by 1.3%, and the CSI 300 in Shanghai also moved into negative territory. The Hang Seng in Hong Kong is up 16% so far this year. Let's go to European markets, which are actively trading. London is down by 0.25 percentage point. The CAC 40 is up by 1.2%, and the German DAX index is is up as well. Actually, it looks like London is not trading today. London finished on Friday and is not trading today, but the DAX and the CAC 40 are trading today. Let's go to the S&P TSX Composite Index. Brianne's going to talk to us about Canadian stocks in just a moment. That's how the index finished on Friday, 25,879 points, up 0.1 percentage point. It was essentially flat last week, while U.S. markets tumbled last week by between 2 and 3%. And for the year so far, the S&P TSX Composite Index is up 4.7%. Contrast that to the S&P 500 down 1.3% so far this year, and the NASDAQ Composite down 3% so far this year. Here's a look at the biggest winners and losers on Friday on the S&P TSX Composite Index. There was a lot of excitement on the uranium stocks based on some policy pronouncements in the United States by U.S. President Donald Trump. So Energy Fuels and NextGen Energy both rallied in a big way. BlackBerry, the Canadian security software maker, down by about 3.2%, and Tilray Brands, a marijuana producer that is deeply into penny stock territory, fell on Friday by 3.25%. Tilray stock now trading at 60 cents Canadian per share. Here's a look at metals. Meanwhile, we'll take a look at gold, silver, and copper. There's gold down by almost a full percentage point to $3,362 per ounce. Silver is also down to $33.55. And copper is flat at $4.84 US per pound. All of those prices, those price levels are historically high prices, not records, but historically high. Here's crude oil. West Texas Intermediate crude flat at $61.53 US per barrel. Here's a look at Western Canadian Select, the Canadian grade of heavy oil, up at the last price point to 51 US dollars per barrel. And you can do the quick math in your head. You can see that the differential between the two is about $10 US per barrel, $10.50 or so. And that, of course, is a narrower spread than historically has been the case between Western Canadian Select and WTI. A big reason is the Trans Mountain Pipeline expansion, which is now shipping oil to non-US markets. Well, Canada's benchmark stock index, as we just noted, has outperformed its U.S. counterparts so far this year. For a closer look, we're joined again by Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners, Raymond James. You've taken a close look, of course, beneath the index numbers at what has really driven the TSX composite higher. And I guess the big question for investors is, can it last? And should investors be overweighting Canadian stocks versus U.S. stocks right now?
Yeah, I mean, we've seen the TSX obviously do extremely well, outperforming the S&P 500, at least year to date, and Canadian equities continue to kind of pull ahead. We're seeing the TSX hitting new highs, but the TSX, again, as you mentioned, looking under the hood, does have lower exposure to tech, and tech has been getting hit, especially with this tariffs. I mean, we just saw the recent with Apple, coming out saying that Apple needs to shift its chip production to the U.S., and I think a lot of these big tech names are being impacted a little bit more by tariffs. And I think the TSX also has more commodity exposure, right? And one of the top performing sectors has been materials. So TSX has been benefiting from exposure to gold and copper. Around 80% of the gains are just from two sectors within the TSX. So that materials sector and financials.
Right.
And 50% of those gains has been from the materials sectors alone. So yes, we're still bullish on, materials and financials that have been carrying the TSX. But, if one of those sectors tends to pull back, or we see a pullback in gold as we're seeing stability in the economy, we may see the TSX start to outperform or underperform the S&P 500 in the second half of the year.
This is a big week for the bank stocks because everybody except Toronto Dominion Bank, which reported last week, will report this week. And the bank stocks have been on fire over the past six weeks or so. What do you think of the banks stocks, profitability performance, and what do you think of the share prices and multiples on the Canadian bank stocks?
Yeah, I think we're so bullish on financial sector, Canadian banks, and U.S. financials too. I think, we still own Royal, like Royal, trimming back or sold our TD position as well, just on these, again, run-up that we've seen in a lot of the Canadian banks and making sure that you are taking profits along the way. I do see, we have been shifting a little bit more now to the U.S. as we're seeing interest rates stay a little bit higher, and with, this new bill being passed, money flowing back into the economy, we see that U.S. financials, I think, will continue to benefit. But even as we've seen, this V-shaped recovery for the TSX, I do think it is important for investors to remember, and a lesson for investors, that recoveries start, when confidence is extremely fragile or consumers aren't feeling like everything is great. And that's when we start to see the markets take off. And we saw that from the TSX, right? And for us, this is also signaling a bullish signal over the next 6 to 12 months. So every time we've seen an extreme sell-off, and this was one of the biggest comebacks, again, in history, going back to the 50s, this ranked the top 15. The next 6 to 12 months, the average return for the markets were anywhere between 20 to 40%. Not saying we're going to get those types of return, but again, it is a more bullish signal for us. I think there's still a lot of political uncertainty. Is Trump going to add more tariffs? He delayed tariffs over the weekend. Some more, what is that doing? But I don't think we're going to see the same types of swings that we saw in April, right? The word tariff mentioned, and the market was swinging 3% a day. I don't think we're going to see that extreme volatility, but I do think investors need to be a little bit braced for some more sideways momentum in the next few weeks. And I think caution on the Canadian economy, right? We are seeing cracks and slowdown, GDP slowing. I think housing market is starting to show signs of slowing. I think unemployment. So for us, if we're looking at an economic standpoint and where we want to be positioned from still upside in an economy, we still see more room to run from the U.S. So we are overweight U.S. at this time.
And in the U.S., I think you've touched on this already, but let's go back there again. You like high quality U.S. stocks. That's a very broad term. How would you define high quality?
Yeah, I think where we are in the business cycle, it is important to focus on quality, not necessarily high flyers, high risk names. Later stages in a business cycle is when you don't need to be taking on as much risk. And for us, that is focusing, and when we could go into a potential recession, or if we are signaling slowdown, to us, you want to be in quality companies that can weather the storm. So for us, staying a little bit away from that small cap space, more in quality, large cap names, not necessarily all dividend payings, but a mix of kind of value growth. I see some value out of the U.S. that's going to do extremely well. And for us, again, just focus on strong balance sheet, strong cash flow, and strong management to lead you out of this.
That's Brianne Gardner and her take on the outperformance of the Canadian stock market and how she's adjusting client portfolios. Up next, retail investors are back into the stock market in a big, big way. It is often considered a contrarian indicator. Should you be concerned? Brianne Gardner tackles that topic when we return. Welcome back. It's time now for On the Radar, which is a closer look at what a money manager is watching in the markets. Brianne Gardner, Senior Wealth Manager at Velocity Investment Partners Raymond James, is back with us, and we're going to talk about the growing presence of retail investors in today's stock market. Today's new figures, I should say, from Bank of America show retail investors have been net buyers of stocks for 21 consecutive weeks. Brianne, you brought that figure to us. What's that telling us about the appetite of retail investors for risk and how the rest of us should think about that?
Yeah, I mean, I think the retail investor, since COVID, we've really seen the retail investor come into the markets hot and heavy, trading, not saying this is a GameStop situation anymore, but I think you are seeing, when you start to see the retail investors pour into the markets, there's a little bit of that FOMO. They don't want to miss out on the bull market. They don't want to miss out on the markets going up. And now that you have consecutively seen the markets going up and a little bit of volatility coming down, that does make I think the retail investor feel a little bit more comfortable or confident in, hey, we're seeing things take off. We see a little bit of stability. We're seeing Trump reduce, some of these tariffs on these countries, that they're feeling confident enough that they can get back into the market. I think it was May 19th, we saw record-breaking buying of $4 billion into U.S. stocks by retail investors by midday. And that was the largest we have ever seen in history. So, there is confidence in there. There is, and some maybe a little too overconfident. As you mentioned in the beginning, sometimes for us that is a little bit of a contrarian sign. Are people too aggressive piling into these markets where valuations are starting to creep up again? And you're starting to see we went from that extreme oversold to now back into overbought territory. So we are watching, everything closely, but seeing the retail investors, this is more than they piled in 2021 recovery and 2022 rallies that we did see. So they are more confident today than they were back then.
You often hear market professionals say there's a long history of retail investors selling at the bottom and buying at the top. Do you accept that, or is it more complex than that?
I do think somewhat, I would agree. I think, technology is starting to improve. I think people access to information, people are starting to feel a little bit more comfortable. The buy the dip is becoming a big trend now, but I think a lot of people say that, and when it comes to it, money is an emotional thing. And, at the lows, when people are starting to feel, could this get worse? This is going back to what we saw in the 70s, this type of correction. People were thinking panic, 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 right? And we actually were buyers on the second lowest day. Did we know it was the lowest? Absolutely not. But we looked at our technical indicators, overvaluation, looking at the extreme fear indicator, looking at volatility, looking at RSI levels, and that's what we really focus on, is removing the emotion out of investing. And I think sometimes a retail investor can let their emotions get the best of them.
And you don't see this rally and the retail participation in the rally as being similar to the meme stock thing, where stocks go up and down on the basis of nothing or a single tweet from an influencer.
Yeah, I mean, we have seen stock or retail investors pile into select stocks too, right? I mean, Tesla is a great one. We saw them heavily piling to that in the last week and a half. But I think it is more targeted bets rather than broad-based. So for us, they are piling into the same thing, Bitcoin or QQQ, so more index funds, not specifically everything. I think they are being a little bit more tailored. And for us, that is saying, again, rather than bad market euphoria, I do think they are being a little bit more tactical. But I would advise, again, making sure that you are taking profits, that you are, as prices are being pushed up, trim back those weights, take some of the profits off the table. And then if the stock drops 5-10%, you can buy back in. I'm not saying sell everything, but I do think it is important for retail investors to learn when to take profits off the table as well.
That's Brianne Gardner on what increased retail participation in the stock markets means to markets and valuations. After the break, we'll have an interview with a credit union expert on why he believes that Canadians should have improved access to credit unions as a big part of Canada's financial institution picture. And our phone lines will open soon for our first call segment. Brianne Gardner is ready to take your questions on Canadian and U.S. large cap stocks. So get ready to call us at 1-855-326-6266 or send us an email right now to firstcall@bellmedia.ca. U.S. President Donald Trump is pushing back the deadline for his planned tariffs on the European Union. Trump has delayed the threatened 50% tariff until July the 9th, after a call with European Commission President Ursula von der Leyen. Von der Leyen says both leaders had a good call and that Europe is ready to advance talks swiftly and decisively to reach a deal. Barrick Mining says the Malayan government's attempt to interfere with its operations in Malaya is without precedent or lawful justification. The Canadian mining company says it remains available to resume talks with authorities to allow for the release of detained employees and resume operations. Last week, a Malayan court postponed a ruling on the Barrick mine until June the 2nd. It's the second time that hearing has been delayed in Mali, the country of Mali. Shares of Nippon Steel are trading higher. This comes after U.S. President Donald Trump announced a planned partnership between U.S. Steel, the Pittsburgh-based giant, and the Japanese company. Trump says the deal is an investment and would involve partial ownership controlled by U.S. Steel, but details remain unclear. Nippon Steel has proposed a $14.1 billion cash takeover of U.S. Steel. Analysts have warned the scale of such a deal could be costly to Nippon in the short term. Well, as Canada welcomes a new federal government and faces continued tariff uncertainty from the U.S., our next guest says one way to strengthen the domestic economy is through the greater availability of credit unions. And he believes that credit unions should be facing a somewhat relaxed regulatory environment in terms of their ability to serve customers across the country. Let's bring in Jeff Guthrie. He's Chief Executive Officer of the Canadian Credit Union Association. Jeff, thanks a lot for coming in.
Good morning.
Why don't we begin with just a basic description of what a credit union is, how it differs fundamentally from a mainstream Canadian bank?
Yeah, very simply, credit unions are owned by their members. So all the profits go back to the members or the communities in which they serve. So it's really what we like to say, it's profit for people, and it goes back to the members.
Right. The banks would say we are owned by our shareholders, and profits in large measure go back to the shareholders in the form of dividends or occasionally share buybacks. Right. How are profit returned to credit union owners?
Really two ways. They can declare a dividend back to the members, or often what happens is they're reinvested in better services. They'll go back into community projects. The big difference is you take three parties to two. It's really the credit union and the members.
And a member of a credit union is who? An account holder, a borrower from a credit union? If you do business with a credit union, if you have your personal finances handled by a credit union, you are a member?
Absolutely. Credit unions offer the same services of the bank. So you can join with a deposit account, go to a mortgage, a loan. So we're one of the biggest supporters of small businesses and small business lending in Canada. So it's really a community-based financial institution.
What you're here to talk about today is your belief and your association's belief that it's too difficult for a credit union established in one part of the country to branch out to other provinces and serve a wider base of customers, correct?
Yeah, I mean, today there's 174 credit unions in Canada. All but 3 are provincially regulated. We have one going through what we call federal continuance, and that has become federally regulated. The biggest difference is provincially you have to deal with, your members have to be within the province, which I think in today's world, people don't really think of themselves as provincially bound. They want the ability to move across the country. So what we're really advocating with the government, let's make it easier for credit unions to serve Canadians wherever they decide to reside.
And Jeff, what is the approach that credit unions have from a lending perspective that might be different than the banks? And kind of, how do you see that either evolving or changing, or where things are going in, let's say, the next 5-10 years?
Yeah, I think the big difference is as a member, we really get to know you as a member. It's really about a one-on-one relationship in the community. It's getting to know, often it's generational. So it's a really much more, they look at lending less about meeting a model and more about meeting the needs of the member.
Yeah. And where do you think things, credit unions could be going over the next 5? Do you think numbers are going to be increasing?
Numbers won't be increasing. We actually see a consolidation of the sector because we need to get scale. And that's why we're advocating with the federal government to allow us a process where we can become federal and grow as the country grows and sort of be part of what's happening now is breaking down these barriers between provinces. They're holding us back, and we need the ability to grow and invest in technology because we all know that we're going to have AI and other things that are coming down the road that it's going to change our financial services experience.
Do you see credit unions consolidating, combining? I don't know if that would take place by way of a takeover or a merger, but do you see individual credit unions getting together to form a larger institution?
Absolutely. We're seeing large consolidation within the sector. Really, if you look at it, these were community-based, sometimes bonded, what they call bonded, so the steel worker would get together and create a credit union. What we need now is a national program that allows credit unions to grow and serve Canadians from coast to coast. And that's really what, I wrote to the Minister Champagne about was let's have a system that very quickly allows us to go through a continuance process and become federally, because today we've got some credit unions topping up 6 years to go through it. And we know a shareholder would never accept a 6-year process, nor should a member of a credit union.
What are you hoping to see over the next couple of years on this front?
So what we're asking the government to do is just a very clear path. So if we're going to go from provincially regulated, I want to go to federally regulated, how long should that take? Is it a 12-month or a 24-month process? We're asking for no change in conditions. We just want a tighter time frame. 6 years is way too long, and we just need to tighten that time frame and really be in a better position to serve Canadians.
Jeff, thanks a lot for coming in today.
My pleasure. Thank you.
Jeff Guthrie is Chief Executive Officer of the Canadian Credit Union Association. Still ahead, today's market drivers with Bloomberg's Divya Balji, and our phone lines are now open. Brianne Gardner is ready to take your questions on Canadian and U.S. large cap stocks. Pick up the phone and give us a call at 1-855-326-6266, or you can still email us at firstcall@bellmedia.ca. Welcome back for a look at some important stories in today's pre-market period. We're joined now by Bloomberg's Divya Balji. She's managing editor for Breaking News Americas and joins us from Toronto. Divya, thanks a lot for joining us. A lot has happened on the trade file and trade and tariff file over the past couple of days. Let's give us a roundup of what U.S. President Donald Trump has said with respect to the European Union and Russia as well.
Yeah, I mean, if you think about it, on Friday, Trump came out and said he was going to tariff or tax the European Union by 50%. There was a deadline for it, which he set in June. And, in a span of a couple of days, like you said, that has kind of flipped, or he's extended the deadline. He did spend time with the Commission's president, and he spoke with her, and they have come together and decided that the deadline will actually be July 9th. Now, July 9th is the deadline for the reciprocal tariffs that he had set in April, so that is one of those dates that I think a lot of us are going to be paying attention to at this point. So you're seeing a bit of relief in the markets because of that. European stocks are up. U.S. equity futures are also up. The U.S. dollar is down. Now, this is one element of it. And then, of course, he was also weighing in on Russia and his frustration with how Putin has been handling the war in Ukraine. He was talking about how he's absolutely considering sanctions or more sanctions on Russia, and that he found, that this is just a bit untenable at this point when it comes to the way Russia is handling things. The Kremlin has already come back and said they feel like this is an emotional reaction that they're seeing from Trump, and they don't seem to be budging at all. So I think that's also something we're going to be waiting to find out a little bit more this week on how Trump is actually going to react to Russia and what Russia could possibly do to sort of bring things down a notch or two.
I know one sector you follow closely, we talk to it about it from time to time on this segment, is the Chinese electric vehicle stock, and there's news there today.
Yeah, I think this is quite interesting too. BYD is one of the biggest sellers of electric vehicle stocks, or cars, I should say. And now we're finding out that they've actually discounted a whole bunch of their models, I think about 22 of them, by as much as 34%, which is huge. If you think about the profit margins that a lot of these cars have, there is a little bit of a concern as to whether this discount is then going to sort of seep into the rest of the market. If you think about it, BYD shares did drop overnight. So did some of its counterparts. Geely was one, Great Wall Motor was another. But if you're going to create a bit of a price war with these discounts, how much further is it going to impact the market? Now, annual sales have been climbing, but the growth of sales, or the growth of the number of cars that have actually been delivered, has declined. Now, some of this you can point to as a slowdown in China's sales, slowdown in what consumers are spending. Is that going to stretch out further? Is Tesla somehow going to be impacted by this? Are there other EV companies or cars models out there that might be impacted as well? So a lot to actually pay attention to and see what's going to happen here. It's clearly a way to look at Chinese spending, or the Chinese market spending, but also how is this going to broaden out to the rest of the world and its economy as well.
Divya, thank you so much, as always, for joining us this morning. That's Divya Balji of Bloomberg News. Up next, we'll bring you our notable call segment. We'll put the spotlight on RB Global, the big auction company, next. Time for notable calls, where we tell you what analysts are doing with their ratings and target prices on high-profile stocks. Today, we put the spotlight on RB Global, once known as Ritchie Brothers Auctioneers. RB Global is the world's largest industrial equipment auctioneer. It's getting a ratings change at National Bank of Canada to sector perform from buy. So that's a downgrade to the equivalent of hold. From buy. The analyst is Maxime Sitchev. We speak to Maxime every now and again here on BNN Bloomberg. He says that while pricing is normalizing after a supply shock in 2022, it will be difficult for the company to maintain double-digit growth going into 2026. Sitchev also says RB Global achieved cost savings from its acquisition of a company called IAA. However, further cost synergies are not likely, he believes. Sitchev maintains his price target on this stock of $115 US per share. We see the stock at Friday's close at 107.18. When we come back, Brianne Gardner takes your questions on Canadian and US large cap stocks. Okay, time for our first call segment, when the viewer gets an opportunity to put a question directly to an investing professional. Today, that's Brianne Gardner. And our first caller is Daniel from Markham. Daniel, thank you so much for calling us today.
Hi, Paul. Hi, Brianne. Great host and guest, and first call, great segment.
Thank you.
My question is on Taiwan Semiconductor. Is this a company you're looking at? What price levels would you start a position, and your overall rating of the stock? Thanks for taking my call.
Yeah, thanks, Daniel. Thanks for the question. Yeah, I mean, it's not a stock I own, but it is definitely on my radar. And as you can see, has participated on that recovery too from the charts on the low in April there. Obviously, world's largest dedicated chip foundry, has been around kind of since '87. For us, looking at a fundamental, it actually scores a 10 out of 10 for us. From a value, a little bit of a 4 out of 10 score. You're still getting a muted dividend yield about that 1.4%, but I still think there's room to run for this stock. Upside potential on the street, you're seeing of about 16, 17%. So looking at that 223 price target per share. So again, quite up there, almost getting back to the highs that we saw kind of January, February for the stock. So again, I would, if you already own this stock, I would continue to hold it from an entry price. Again, I think the sector might be a little bit volatile from here. So for me, I would wait to kind of pull back a little bit around maybe that 178, 175 to kind of get back in. But for me, yeah, this looks like a great stock that I have on my watch list. Okay, thanks, Daniel, for your question on Taiwan Semiconductor. Let's go to Manitoba now. Sly is on the phone. Hi, Sly.
Hello, how are you?
Good.
Good. My question is on Cord Energy. I acquired this stock through the Enter Plus purchase, and it pays a nice 7% dividend. What do you think for a long-term hold, as I'm kind of underwater right now? Thank you very much.
Yeah, Chord Energy, not a stock that I do own. As you can see, kind of has been in a little bit of a downtrend over the past year there. From a value perspective, it's showing a lot of upside potential, 47 or almost 50% upside from here. Analysts on the street, you're seeing a little bit of a buyer outperform. To me, it's a little bit too risky right now. Again, I know you mentioned you're a holder, so, I think sometimes looking at trends and knowing when to cut your losses. But for here, if you've been holding it for a while, it looks like you could have a strong support kind of a little bit lower. You might have a little bit more weakness before things turn around. If I was looking to add into the position, I would wait for a conviction of a turnaround before then. But again, I still think you're collecting a decent dividend yield, and there is potential upside. And again, a value, you're looking at a 10 out of 10.
The company is a Houston, Texas-based oil and gas producer, and I can tell you, Sly, that analysts who cover the stock are decidedly bullish. There are 19 analysts who cover the stock. 15 of those 19 say buy, and the price target that's derived from that survey is almost $137 US per share. That's versus the current share price of about 90. So analysts who cover Chord are bullish. Let's go to our next caller, Dave from St. Catharines. Dave, thank you very much for your call.
Oh, thank you, Paul, and thank you, Brianne, for taking my call. My question today is on Royal Bank. I know that it's reporting this week, and I'd just like to know how you think it's going to do in the next year or so. Thank you very much. Bye-bye.
Yeah. Thanks for the question, Dave. Royal Bank, obviously one of the two largest banks in Canada, over $2 trillion in assets, has also participated, and you've seen that extreme run up, almost getting back to those new highs for Royal there. It is a stock that we do own in the portfolio. From a fundamental score and value score, we still see an 8 out of 10. Royal has a stable business model. You're still collecting a decent yield from the Canadian financial banks. Upside potential from here, though, is a little bit more limited. I think, again, if you are a long-time holder and are comfortable with a little bit more volatility, but from an entry point of adding here, I wouldn't be adding. I think Royal, looking at the latest earnings that they've had, the last 3-4 quarters have beat, so we expect that from Royal too. Okay, thanks
thanks to Dave from St. Catharines for his question. Let's go to Anita. Anita is in Markham, Ontario. Anita, thank you for your call.
Good morning, Paul and Brianne, for taking my call. My question is on freehold royalties. Brianne, what do you think of this stock? Is it a good time to get in, and whether the dividends are safe at this point? I'll hang up and listen to you. Thank you so much.
Thank you, Anita, for the question. Obviously, Freehold, is in acquiring and managing kind of the oil and gas royalties. A little bit more of a volatile stock. I think, they do operate in main two segments, Canada, which include exploration in the natural gas and kind of that petroleum in Western Canada and the U.S. as well. Looking at the upside potential from here, there is about 25% upside analysts are seeing on the street. So you're seeing a little bit of mix between hold, outperform, and buy. But again, you do have a decent, healthy dividend yield there, and is looking pretty attractive from a value score. Again, not a stock that I do own, but if I was a holder of this position, I would continue to hold.
Okay, thanks, Anita, for your question. Let's go to Jimmy. Jimmy's in Welland, Ontario. Jimmy, thank you for your call.
Good morning, Paul. Question this morning for your brilliant guest, Brianne. Looking at the technocom paradigm that we're experiencing, BCE, are we trailing the U.S.? What are we looking forward to at BCE?
Okay, lots of news on that stock. And as we always do, we remind viewers that BCE is the parent of this television channel through BCE's Bell Media division. Brianne.
Yeah, I think we've seen a little bit of pressure under BCE over the last year or so. And obviously, the company and the stock has felt that. Still a great quality company, though, right? Providing kind of wireless, broadband, television, landline, phone services in Canada. If we were to do apples and apples, we would prefer TELUS just from a stock perspective. And fundamentally, I think if you're looking at even value, from here, yes, there's some upside, but I think there's still a little bit of risk. I mean, that choppy we've seen in the stock, as you can see there, those are some pretty big swings for investors to stomach, even in the telco sector, and that's just TELUS alone. So, I think, between BCE or TELUS, I prefer TELUS, but I think the telco sector has been dragged down. I think there still is upside to go in that space, and the valuation haven't been fully appreciated in that sector. However, we continue to hold TELUS instead of BCE. I still think BCE has a little bit more caution to climb out of before we see a turnaround in that stock.
And Jimmy, analysts are cautious on shares of BCE. There are a total of 14 analysts who cover the stock. 8 of 14 say hold, and 5 of 14 say sell shares of BCE. Here comes an email from Mike. Could I please get your guest's opinion of waste management for a long-term hold?
Yeah, thanks, Mike, for the question. Waste management has definitely been a stock I've been following for a while. I think even since COVID, we've traded the stock a few times. For us, it ranks at 8 out of 10 fundamentally. From here, I mean, you have seen quite a rally up. Didn't really participate in the January rally that we saw, but since then, since the January lows, the stock has taken off. Quite volatile, though, about 5% upside, looking around that $248 per share I see it at. For me, it's a little bit of a mix from here. I would say it's a hold for me. Year to date, the stock's up about 18%. 1 year, you're seeing there on the chart about 12.8. 2024 stock had a great run, was up 14%, and 5-year return we're seeing about 21, and 10-year return about 19. So again, it is a great quality company that has had consistent long-term returns, but I would be looking at taking some profits here.
Brianne, thank you so much for being here with us again today.
Yeah, thanks for having me as always.
Brianne Gardner was our featured guest. Always great to have her and her insight along. And thank you to all those viewers who put questions to Brianne during our first call segment. Well, thank you so much for watching The Street. Andrew Bell and the Open is up next. As we go, here's a quick look at the TSX market site. We're trading set to begin in about 33 minutes from now.